Hello viewers, welcome to my channel. I'm Hasham. This is the third video on finance function. The last two videos I have explained you about the meaning of the term financial management, scope of financial management, functions of finance manager, and lastly I have explained you about the importance of financial management. In this video I am going to explain you about the goals or objectives of financial management. In examination, frequently they will ask this question, particularly, what is the objective of financial management or what are the goals of financial management? So watch this video to get the complete knowledge about the objectives of financial management. So before proceeding, I have to take the screenshot of the points which I have written on the board. Then I'll explain. So there is a controversy regarding the precise objective of financial management. There is no unanimous or unanimity regarding the objective of financial management. Different people will say different things regarding what should be the objective of financial management. No precise objective is there. So many people will argue that financial manager should always attempt to maximize the profit. Maximize the profit of the enterprise. Therefore, the main objective of financial management is maximizing the profit. Many people will argue that the objective of the business is to earn the profit, is to maximize the profit. Hence, the objective of finance manager, the objective of financial management should also be to maximize the profit. That is the opinion of many people. Many people will argue. In other words, while considering the financing, investment or any other relevant decision, the finance manager should examine each alternative with reference to whether or not it will increase the profit or not. A finance manager will take so many decisions like investing decision, financing decision, dividend decision, and many other financial decisions. So while taking those decisions, the finance manager has to see what will be the impact of that decision on profit. If the decision increases the profit, then the decision will be taken. So every decision we have to consider what is the effect on the profit. That is the objective. There are another view that profit maximization can at best be limited objective, and that in many situations maximization of profit may be conducive to the long-term interest of the company. This is because of the following reasons. So many people will argue that profit maximization is the goal, is the objective of business and objective of financial management. But many people will not agree this view. Many people will say that profit maximization at best is a limited objective, not a long-term objective, not the precise objective. Because if we keep profit maximization as an objective, the objective will be too narrow. Our objective, the business objective, should be very large. It should not have a narrow objective of just to maximize the profit. That is the opinion. Why we should not keep profit maximization as the sole objective? There are some reasons. The reasons are why the profit maximization objective should not be kept. The first reason, maximizing of profit as an objective ignores the risk factor. See here, there is always a direct relationship between risk and return. Higher the risk, there is more possibility of return. So when we focus only on return, automatically it means risk is also coming along with the return. Because risk is attached with return. Higher the risk, higher the return. So if we focus only on return, only on profit, that means automatically we are taking the risk also. So if a business gives more importance to profit, keep profit maximization as an objective, then they will take every activity which increase the profit. Automatically it is taking the risk also. So first point against profit maximization is profit maximization is ignoring the risk factor. So while taking profit, we must consider the risk. Secondly, profit maximization as an objective is too narrow. Just now I told you, simply keeping profit maximization is too narrow because it is ignoring other consideration. Remember, a business is a part of the society. That means business has obligations against so many parties. It does not have obligation only to the owners. It has an obligation towards the employees, towards the workers, towards the society, towards the consumers, towards the government. So many parties are there who are having a stake in the company. The company should satisfy all the parties. They should not satisfy only one sector, that is owner. Right? So profit maximization keeping as an objective is too narrow, since it fails to take into account the social consideration as also the obligation of the enterprise to various interests like workers, consumers, and the society at large. So a business organization has so many obligations for different parties. That must also be considered as an objective. Should not take only profit maximization as an objective. Nowadays, in the present generation, if any business keep profit maximization as the only objective, nothing else, that means the business will not survive for long. The business cannot go for long because it is ignoring all other considerations. Now, similarly, maximization of profit without any regard to ethical practices can never be the objective of the business organization. We have to follow some ethics. Ethics means what is good, what is bad. So from business point of view, it has to follow the ethical principles, ethical rules. If a business follows ethical rules, there is a possibility that the business may go for a long period of time. Otherwise, if we ignore ethics and simply focus only on profit, the business cannot go for long. Now, profit maximization in absolute terms ignores the time pattern of returns. See here, if we keep profit maximization as an objective, we simply calculate what is the earning per share, 1 year, 2 year, 3 year. Simply we are comparing the earnings, EPS of the company to see whether the business is attaining the objective or not. Ignoring the time pattern. We all know there is a time value of money. Today's money is having more value than the future money. So on account of interest, on account of uncertainties, on account of inflation, the future money will have a lower value than the present value, right? That factor is ignored when we keep profit maximization of objective because we are ignoring the time pattern. We are simply comparing what was the EPS 5 years back and what is the EPS right now. Simply by comparing EPS, we are saying that we have attained the objective. No, you cannot compare the value 5 years back with the current value. 5 years back, the value of money was more. Presently, the value of money has come down. So you cannot compare two values at two different periods of time. That is the drawback of keeping profit maximization as an objective. Now, in view of the arguments, the three arguments are against keeping profit maximization as an objective. So it's a fact that in today's business we should not keep only focus on profit. Profit, no matter, it's very important. Without profit, no business can survive. But we should not take profit as the sole objective of the business. The business exists only to earn the profit. That is wrong. So, after seeing all the arguments against profit maximization, what is the alternative objective? Here, in view of the arguments given above, many authors argue that finance managers should keep wealth maximization as an objective. Now I am coming to the next objective. The traditional objective, old objective was profit maximization. But the present objective of the business is not profit maximization, it is wealth maximization. That's why profit versus wealth. So what is wealth maximization? Now I am going to explain you. So maximization of wealth implies the financial objective of a firm should be to maximize the market value of shares. Wealth maximization means whose wealth? Shareholders' wealth, the owner's wealth. When the shareholders' wealth will get maximized, when the market price of share increases. Suppose I have purchased some shares of XYZ company for 1 lakh rupees some 10 years back. The company is performing very good. All financial decisions of the company are excellent. Then what will happen? The company is becoming prosperous. The company is progressing every year. When the company is earning more profit, the market price of share have increased. I have purchased the shares 10 years back for 1 lakh. Now if I sell the shares right now, it is getting 20 lakh. It may happen. It may happen. So that means only 1 lakh rupees investment I made 10 years back. Now the value has become 20 lakh. That means my wealth has increased. How the wealth have been increased? The market price of share have increased. How the market price of share have increased? The company has become prosperous. The company is satisfying the interest of all stakeholders. The company is not considering only one stakeholder, that is owner. The company is considering all stakeholders. The company is following all ethical practices. Then definitely in the long run, the company will grow. So in other words, the finance manager should attempt to maximize the value of price of the company's common stock. Now, presently, throughout the world, the objective of financial management is to maximize the wealth. How the wealth is maximized? When the market price of share increases. Actually, market price of share depends on the demand and supply of the shares. If the demand of share is more in the market, then market price will shoot up. If there is no demand, everybody wants to sell away the shares in the market price will come down. So finance manager has to see, always keep a track the movement of share prices in the stock exchange. If in the stock exchange the market price is increasing, it shows that the finance manager is taking the right decisions. The business is taking good decisions, particularly in financial management. Then this price takes into account the present and prospective future earnings per share. Whatever market price is there, what it reflects, what it shows the present and prospective earnings per share. How much presently the company is earning and how much the company may earn in future, prospective earnings. And also the timing and the risk of these earnings. Not only it takes into account the earnings, but also the market price will takes into account the risk factor of earnings, the time pattern of earnings, apart from that the dividend policy of the enterprise and many other factors. See here, the dividend policy, financing policy, investment policy, all these decisions which are taken by the management in the company is reflected in the market price of share. So this market price of share, if it is increasing, it does not mean only to one factor. It means many factors are responsible for the increase in the market price of share. And every finance manager main objective is to see whether market price of share is increasing or not. If it is increasing, the company has attained the objective of financial management. Next comes, it is thus an overall reflection of investment, financing and dividend distribution. Just now I told you, this market price of share reflects the decision taken by the manager, finance manager regarding investment, financing or dividend decision. The market price of company share represents the focal judgment of all participants in the markets as what is the value of the particular company. See here, this is just a barometer. By seeing the price in the market, share market, we can be able to see what value the company, what is the value the participants have given on the company. Who are the participants? A business will have so many stakeholders. In a business, we have owners, we have employees, we have customers, we have suppliers, we have bankers, we have government, public, all these are the participants in the market. How the participants are viewing the company. If all the participants are giving a premium to the company, then the value of the company is increasing. So if anybody wants to see whether a company is a growing company or not, whether we should invest the money in a company or not, the focal judgment is the market price. Everybody is seeing the market price. So here, the finance manager should also keep his objective as maximizing the share price. In this way, maximizing the wealth of the shareholders. The finance manager should attempt to maximize this value. The objective of FM, financial management, is to maximize the firm's wealth through the process of increased value of shares. So every step, whatever activity the finance manager is taking, the finance manager has to see that this decision, what is the effect on market price. If we take a decision on investment, if we take a decision on financing, what will happen on the market price of share? That should be seen by the finance manager. The market price serves as a performance index or report card of the firm's progress. Just now I told you, we can be able to see the performance index or report card by seeing the market price. The market price will tell everything about the company. It indicates how well management is doing on behalf of stakeholders. So the business is run by the management. The decision will be taken by the management. The stakeholders, the shareholders have appointed management to run the business. How efficiently, effectively the management is doing its activity, that is reflected in the market price of shares. Now, ultimately, this objective is called wealth maximization objective. This objective of financial management is called wealth objective. Now, the goal of financial management may be such that they should beneficial to owners, management, employees, and customers. So, any decision taken, we have to see how much it is beneficial to every stakeholder of the business, to the management, to the customer, to the owner, to the supplier, to the government, to the public. How it is beneficial to everyone. Now, these goals may be achieved by only maximizing the value of the firm. The elements involved in maximizing the value of the firm is as follows. So, how a business can be able to maximize the value of share in the market, due to which there is wealth maximization to the shareholders. So, what are the elements? The first element is increasing in profits. When profits increases, automatically the value of share in the market will also increase. How the profit will increase? When the company should try to increase the sales revenue. The sales revenue should be increased by adopting different methods of promoting the sales. And apart from that, making innovation in the product, making quality product, satisfying the consumers, and removing the grievances of the consumers. All these things, if the company applies, then sales will increase. When sales increases, profit will also increase. When profit increases, automatically the market price will also increase. Secondly, reduction in cost. See, from whichever source the company is raising the funds, the company will incur cost. Example, when the company issues shares, there is an obligation to pay dividend on shares because the investors are investing to get the dividend. So, dividend will be paid on shares. Similarly, when the company issues debentures, interest will be paid on debentures. When the company takes a loan from bank, the company has to pay interest on loan from bank. So, this dividend and interest is the cost. So, company has to raise the funds where the cost of capital should be minimum. When the cost of capital is minimum, then total cost will decrease. When total cost decreases, the profitability will increase. This is the second element. The third element is sources of funds. Financing decisions are those decisions where The finance manager has to make a combination of different sources of funds. Different sources of funds means we must procure the funds through equity, through preference, through debentures, through bank loan, through public deposits. Different sources are there. The combination of all these are called capital structure or finance mix. There should be a proper finance mix. If there is imbalance between debt and equity, then definitely the market price will not increase. So there is a relationship between making an adequate, excellent product mix, due to which the cost of capital will come down. When the cost of capital comes down, the profitability will increase. When the profitability increases, the market price of share will also increase. So making a right finance mix is one of the necessity. Next one is minimizing the risk. See here, actually the traditional view was risk is bad. Risk should not be taken. But during the modern times, if a business does not take into account the risk, the return will be less. Because higher the risk, higher the return, lower the risk, lower the return. So if a business does not want to take the risk, then what will happen? The profitability will come down. So presently, the business has to take the risk, but it should control the risk. It should minimize the risk. Nowadays, there are different techniques of minimizing the risk. Diversification. By making diversified activities, the risk will come down. Similarly, by entering into derivatives market, the business can be able to reduce the risk. So in this way, in order to maximize the market price of share, the company has to minimize the risk, control the risk. Last one is long run value. See here, in order to achieve short-term success, the business may go for short-term tricks. For example, increasing immediately the selling price or compromising with the quality of the goods. Like that, small gimmicks are there, small short tricks are there, through which the company can be able to increase the profitability. But this is only short run. The business cannot be able to fool the people all the time. The business can fool the people only for some time. So that means only for some period of time, the business can be able to increase the profit. But in the long run, the business will collapse. So by seeing the market price of share, it should see the long-term perspective of the business. Any decision taken, we have to consider what will be the long-term impact on the business. So these are the elements of keeping wealth maximization as an objective. So very frequently asked in examination regarding this question, what are the goals or what is the objective of financial management? So this video will be very, very helpful in writing the theory regarding this topic. So if you want the complete knowledge, watch all the videos from beginning till end. So for these 3 videos, I have so far prepared on financial management. And apart from that, all techniques videos already I have uploaded. So frequently visit the playlist of my channel. Select so many subjects videos I have uploaded. Select your subject, watch the video, enhance your knowledge. Be blessed with immense knowledge. And if you are satisfied, give a like to the video, share my channel among your groups, among your friends, so that more students can watch the video and enhance the knowledge. Subscribe my channel if you have not yet subscribed. Inshallah, we'll continue the next topic in the next video.